Good morning, it's Jeffrey Cohen, June 28th, it's Tuesday, here for your Chicago Quantum bear market rally discussion. Hopefully you're doing well out there. We're just going to do a quick look. So you're going to read a lot about how people are talking about whether we're in a recession or not. We heard that Kathy Wood, with ARK, she says we're already in a recession. Lots of people talking about it. So game theory suggests if there's two actors and they both think that there might be a recession, but it's not confirmed, do you buy, do you sell, do you hold when you're not sure if there's a recession? Well, the first thing is if everyone buys or holds, then the payoff is zero because the stocks don't drop. Everyone's fine, everyone's happy. If everybody sells, everybody loses. Because there's no one there to buy. The only winner is the new buyer. So you hold, if you have stock and I have stock and we both sell, we both lose. However, if one of us buys and the other one sells, then whoever sells first gets the higher price. And then the market drops, the next guy to sell loses. And it's either way. So what happens is you start in the model with the best outcome, which is we all hold through a recession. And then somebody says, you know what, I'm going to do better off. I'm going to sell first. While that other sucker is going to hold, right? So sell, hold. I'm going to sell. And the other guy goes, you know what, I'm going to sell while the other sucker holds. And by the end of it, everyone sells, stocks drop, there's nowhere to run. This is our game theory model for this market where we are now until the recession data is true. So we look at the S&P 500. I just think it's important, just a 5-day look. Okay, Jeffrey, where are we with the S&P 500? Well, where we are is you see the model is in a committed, this is a trend line. It's a committed downturn. It wasn't an upturn, and it actually crossed in end of December of last year. And so what's happening is you have the S&P 500, there's a trend line, boom, 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 and it's bounced up off the trend. So it's 200 points. It's nice. It's 5% rally. So it's a bear market rally. The market is falling, and a 5% rise doesn't mean that we're safe. A couple things to point out. The Japanese yen is at 136.2. So Japan is having so much problems right now that their currency is collapsing. Now it's good for us because it means our imports from Japan are cheaper, but it also means our exports to Japan are more expensive, so they're not going to buy any American products. Come on. The yuan, the Chinese currency, the renminbi, 6.7. It is also not crashing because the Chinese keep their currency in a certain limit. But Chinese products are cheaper. This is one way to help fight inflation. I don't know, President Biden, if this is what you're doing. But by getting other countries to weaken their currency, they sell us their crap cheaper. Mexico. We're almost at 20 pesos per dollar. Weak. The euro slightly strengthening. It's 105.52 for the euro dollar. So for our major partner in crime, right, we've got Europe. It's one thing. But major trading partners, oh yeah, their currencies are weakening. They are going to sell. They're going to dump their products into the United States to avoid their own recession. Whereas our manufacturers won't be able to stand a chance. So just interesting when you look at it. The VIX is down to 27. So the challenge with this number, the VIX at 27, I mean, I like when the cost of hedging your risk goes down. Why wouldn't you, right? Look at how this VIX is moving. So what happens is the perception of volatility in the market is up and down. Now, where's my data? Where's my numbers? So we run our model, and I got to tell you, what we find, yeah, here it is. variance of the S&P 500, 1.55 times 10 to the negative 4. That variance is really high. It's higher than we've seen it. You know, it used to be 9 times 10 to the negative 5. It's up 50% since we started looking at it. Variance of the S&P 500. So insurance on the S&P 500, in fact, should be higher. Now, back here, in 2019, you were at 12. Fine. So it's double. Fine, I got it. Back here, you were at like 15 to 20, and now you're at 27. So I'm not seeing it. The S&P 500 variance is up. By the way, the return of the S&P 500, down about 6.4% after dividends. The Russell's down 23% past dividends, and the QQQ, or the NASDAQ Composite 100, is down about 15.25%, inclusive of dividends that they paid. So it's interesting, right? You have a market that is down, that is dropping, that is more variable, more volatile, and by the way, the risk-free rate of return that you can get in the bank, we've jacked that up in our model to 1.5%. That dropped the market return for risk assets to 3.5%. Why would you put your money in the stock market to earn, let's say, 5%? That's crazy. You can earn 1.5% in the bank and sleep like a baby. So let's take a look. Well, first off, let's see. Where are we with interest rates, right? Well, the 1-month Treasury bill is yielding 1.13%. It is not really up per se, but you can see over the 5 days, this is when the S&P 500 went up 5 days. Up 5 days. I'm tying this back to S&P 500, up 5 days. This is a bear market rally. Interest rates, up 5 days. Not a ton. It's up from like 1.055 to 1.113. Okay. How about, Jeffrey, the 10-year over the same 5 days? Oh, it dropped, which made the market go up, but now it's coming back up again. It's not quite where it was. So the 10-year, which is the currency of quantitative tightening, because they use 10-year Treasury notes. They also use those for reverse repo. This is your, William Gibson called the $100 bill the currency of bad shit, right? Like things happen with the $100 bill or the 500 euro bill because it's lightweight and very valuable. So the 10-year Treasury is the same thing. It's the thing that you use to do things. Now, the 30-year Treasury, there aren't that many of them, but it's super sensitive to rates. You're at 3.56%. You're up today. How are we for 5 days? We are now just above where we were 5 days ago. So now the market is facing headwinds. Your S&P 500 is down, let's say, 6.4% for the year. So most people are underwater. And now you're looking at rising interest rates. Yeah. Not helpful. And the VIX is trailing down, which are conflicting messages. If we take a look, this is using CoiFin 5 days with the S&P 500, the NASDAQ, and the Russell. You can see for 3 days they were pretty much building a base. And now they're up. It's like a new base, but I'm struggling with this one. Maybe it keeps going up. It's fine, right? So large cap was weakest yesterday. Now that's interesting because when we looked at our spreadsheet that our model kicks out, it's the large caps that scored the best in our model. And that's because in general, they have lower risk. So Apple, NVIDIA, Microsoft, Alphabet, Berkshire Hathaway. So not a lot of them. BlackRock's pretty big. But you're looking at Apple, Nvidia, Microsoft are top. So those have not done well. Those are flatlining. So what happens is your slope when you bottom hits zero. So your riskiness, your volatility on a downward sloping price curve approaches zero. That is so interesting because you end up feeling like you're in the calm before the storm. You're safe, right? Because it's not moving. Well, that's true, especially if you've bottomed and you're consolidating and now you're going to jack higher. But if you're just consolidating, so if you're consolidating to go higher, that's great. If you're consolidating to go lower, that's not so great. By the way, the S&P 500 tends to not consolidate to go lower. So in general, like here, a tiny consolidation for like a week, and then it dropped. Then it consolidated, it went up. The S&P 500 is not a consolidate to go up. It's just takes a little breath, goes down, takes a little breath, comes up. So the model likes it when stocks take a breath for a year because it means that the risk is gone, the trading is gone, and now you just have kind of rock solid valuation. We're just not seeing that in the market because of the riskiness and the volatility. 1.55 times 10 to the negative 4 is the adjusted closing price, daily price volatility, or variance. It's up. What else are we going to look at today? Foreign exchange. We talked about the Japanese yen. Look at that. I mean, it took a little break, but it's up again. It's not helpful. So what this means to you is we're not going to sell much into Japan. Japan's selling to us. And Japan has its own issues. Japan is fighting to keep its interest rates low, to let its economy expand. And it's just destroying its currency. It's also destroying its balance sheet. It's buying up bonds. I thought countries are supposed to raise money to pay for deficits by selling bonds. Why do they buy them back? Oh, Great British Pound is down. Sound as a pound. Nope. 1.22. 1.54 dropping. The euro dollar's dropping. Okay? Canadian dollar, 128. Dropping. Actually, this is, this means, I'm sorry. It actually means the Canadian dollar is getting stronger because at $1.30, the Canadian dollar is trading like a 30% discount. Now it's a 29%, 28% discount. So Canadian dollar is actually strengthening, which is good. Everything else seems to be weakening. And so it's crazy talk out there. What's the news say? This is interesting. This is why I made this video. ARK Invest, Kathy Wood says the U.S. is already in a recession. Earnings recession coming. Just going to do a quick search on this page for the word recession. It shows up 5 times. Uncomfortably high chance of a recession. Recession woes. So I don't. Oh, Powell, which is the chairman of the Federal Reserve Bank, pledges to beat inflation even if it causes a recession and job losses. Okay. So hell with you people. We've got a job to do. We're going to break inflation even if it means we cause a recession. So I look at this and I think, all right, it's a lot of tough talk, right? But then I see some glimmers of hope, right? It's not all gloom and doom. So you look at the NASDAQ yesterday and the S&P 500 yesterday. It fell in the first 2 candles. So maybe in the first half hour. Then it went up. Then it came down. One of the worries I have is that it tested lows of the day towards the end at 38.90. So my guess is we're going to see 38.90 today. And NASDAQ did the same thing, 11,500, and then it hit 11,500, and then it came a little bit below. And so if we look at the market, what are we going to see? Jeffrey, what do you see? What's your crystal ball tell you for today? Honestly, my crystal ball tells me that energy's going up because somehow they're making a deal with the president. By the way, do you know that the president released more oil out of the Strategic Petroleum Reserve? I told my wife this was good news. So the good news is our Strategic Petroleum Reserve is under 500 million barrels. It's the lowest it's been since 1998. If we continue to release oil, President Biden, when there's a war, there's a crisis, we're not going to have any oil. So we're going to be begging the rest of the world. Maybe we could go and beg Saudi Arabia or Russia for oil, or Venezuela, or Iraq. Just let's do it. But we don't want Canadian oil. That's stupid. No XL pipeline. So we're going to beg foreign countries that are not our friends for oil. Okay. Well, the one good news is if we drain the Strategic Petroleum Reserve, that's a huge bunker. We could use that and make an amusement park. Probably put in like roller coasters and stuff. It's amazing. It's a salt flat, I believe. So you get in there and it like holds the oil so we can get in there and make like an amusement park. That's cool. Let's do that. I'm joking. It's so stupid. We're giving up our oil. So the oil companies like that because once the U.S. has no Strategic Petroleum Reserve, we're really beholden to the oil companies to keep our economy moving. So yesterday, you had some stocks went up, energy stocks, of course, but the big guys went down. And so I guess what I'm saying to you is this is a tough market because people are selling the big stuff, but somehow they're pushing up the indices so that everything looks okay. So sell what's liquid, keep up appearances, and rock and roll. I did notice that the new high to new low, 30 new highs yesterday, 138 new lows. So that 4.5 to 1 ratio is the best we've seen in a long time. And I'm guessing if we look at FINRA, it's going to be the same thing with bonds. No, it is not the same thing with bonds. It's 18 to 1, 19 to 1. New highs, new lows for corporate debt. So for stocks, it was 4.5 to 1. For equities, it was 19 to 1, which means equity investment grade, it's 20 to 1, 18 to 1. High yield, wow. It's 40, 45 to 1. So high yield is crashing. Okay, so we're still not out of the woods in terms of the real economy, like paying off our bills, corporate bonds being paid on time. Not saying it's not happening. I don't know about defaults, but what I could say is that the expected return people want, that people are demanding from corporate bonds, has gone up. And I would say that the expected return that people are going to demand from the S&P 500 is also going to go up. Because right now, the expected return from our model is like 4.7%. People don't hold stocks for that. So, as you go into your trading day, the dollar and foreign currencies are doing some weird stuff. Bitcoin is staying true to around 21,000 a coin. Big stocks were down yesterday, but the indices flat to lower. Big stocks fell yesterday. Liquidity. Big stocks fell. And the futures say, don't worry, we're going to be up in the morning. So I had on a green sweatshirt earlier, but I can't wear it in good conscience. I can't tell you the market's going up. Is this green sweatshirt? I can't wear it. Can't do it. This is a bear market rally. It's a rally, intermediate rally, or maybe even a short-term rally in a bear market. And you see the bond bonds, 134.34. It's terrible for companies that hold fixed income assets. So, sorry, Green. Hope you have a safe day today. Now, in order to show you that I'm not just blowing smoke, if you go to our homepage and you look at the stocks that we hold, so you go home, stocks held by advisors. What do we have? What are we doing? Jeff, I think you talk a good story, right? Where are you putting your money? So, as of June 15, at 4 p.m., we were long in Corbus Pharmaceutical. My joke is we're underwater for so long on this stock that we're scuba diving. And AMS, American Shared Hospital Services, we're down a little. They're longer term holdings. They're pretty much hitting the long-term holding period. We are short the common, and we're long on puts for Lakeland Financial Corp. We are also have out-of-the-money puts on Bank of Hawaii. Not that many. We didn't pay that much, but we are long out-of-the-money puts on Bank of Hawaii. And I'm going to share with you why that is. I wasn't going to do that, but now I'm going to do that for you. I'm going to talk about it. Holdings. Why? Because I feel like I got to disclose it for you. So first off, I'm down 49% of my holdings. I hate myself right now. So we bought puts. And unfortunately, the puts don't trade. So they're all July for Bank of Hawaii, $60, $65, and $75 puts. The underlying trades at $76.69. So we are out of the money. None of these are paying. This is all money down the drain. Now, what's interesting is I believe that the Bank of Hawaii trades at 2.1 times equity valuation. I believe the Bank of Hawaii has negative AOCI, which is accumulated other consolidated income. And that AOCI is going to be extremely negative in the quarter ending in 2 days. End of June, June 30. So they're going to have an earnings release that's going to say, "Oh, we did great. We had new loans, and we opened up a new branch, and we feel so good. It's sunny in Hawaii." But you know what they're not going to tell you? We're holding bonds, and we're holding mortgage-backed securities. And this is the S&P mortgage-backed security for 6 months. Oh yeah, we bought them at 25. End of March, they were at 24. Now they're at 23. So, losing money on mortgage-backed securities. How about if they had 5-year money? Where's 5-year? Here we go. Where are you at with the 5-year? Oh yeah, 6 years ago, Jeff. 6 months ago, Jeff. It was a 121. We loved it. We loved the 5-year money. Well, we lost a little bit. You know, end of March, we were at 115. Oh, we're at 110. So if we have 5-year money invested, we lost another 5%. Now I got to tell you, the FDIC is going to hold the bag on small depositors and make sure that nobody gets hurt. But if you're a large depositor in Bank of Hawaii, let's say you got $100 million and you put it into Bank of Hawaii, you got to go into your bank, ask your bank teller, so why do you have all these mortgage-backed securities and investments? Why is that? You're going to lose money probably at the end of the quarter. And since you're trading at 2.1 times equity book value, for every dollar you lose, you're probably going to lose $2 in equity valuation. Lakeland Financial also has very big britches. They put a lot of money into those investments, mortgage-backed securities, bonds, but their bonds are longer. They're 5 to 10 years. Jeffrey, how are we doing with the 10-year? Well, do I even have a good 10-year? That's 30-year, 10-year. Let's do this. Let's look at the 30-year, and we'll roll with it, right? We'll just kind of mark it down a little. So if you held 30-year bonds at the end of the year, you were at 160. And to March, 150, 149.5. Oh, you're at 134 now. That's a 10% decline. 8% decline. So, I don't know. AOCI is going to be very negative for community banks that are making large investments. And this is another one that trades at like over 2 times book. So every dollar you lose, you're going to lose $2 in your stock. So the question is, how much does Lakeland Financial even have to lose in their valuation? So it's worth $1.69 billion. And we're going to look at the financials here. We're not going to look at it in the balance sheet. By the way, I know you're always supposed to go to the 10Q. Common stock equity is $609 million. 609 million. It used to be 704 million, but they lost $100 million in the stock market or in the bond market. So how many are they going to lose? Another 100 million, which takes them down to 509. I don't know. But if they did, if they lost 100 million and it went to 509, do you really think the market cap is going to stay 1.7 billion? Do you think that depositors are going to keep their money in that bank? We do the same thing with Bank of Hawaii. Now, I'm not trying to cause a run on these banks, but I just got to tell you, it makes me sick to think that the bankers are earning bonuses for doing this. So let's take a look. Balance sheet, quarterly. Again, you can't really trust Yahoo Finance. You got to do your own due diligence here. But common stock equity is $1.27 billion. It's down from 1.43 a quarter ago. So they lost $160 million last quarter. Although it says that they made a profit, yeah, they lost $160 million of shareholder equity. What are they going to lose this quarter? Another $160 million? You're going to go down to 1.1? So what's the company worth? It's worth 3.1. So you're going to go to 1.1. Do you think the market cap's going to stay at 3.1? Do you think anyone is going to feel safe buying Bank of Hawaii stock, keeping their money in the bank? Now, the small investors, sure, because the FDIC is covering them, but that's only $250,000. Big money's going to leave. We found 2 of these stocks that were trading using our model, using our spreadsheet, which I talked about in my other video, basically using what's market cap, what's cash flow and net income, what's common equity, what's AOCI. We were able to find banks that were dramatically overpriced. And we were able to make short investments. Basically, we're either short or we bought out of the money puts because we believe that the market's going to catch up. So I want to thank you for listening. I can't believe I just talked about LKFN and BOH. But hopefully it helps you. Hopefully you don't have all your life savings in there. And hit the subscribe button, right? What it does is it's free to you. You get notifications if we're making a new video. Sometimes we're, like this one, impromptu. It also tells YouTube that you liked it so that they share it with more people. We don't pay for advertising. We don't get paid to make the videos. Also, we like to have a little commentary. So if you want to leave a comment below, we'll respond. Or we'll just wave and say thank you. All right, you take care now. Have a great day in the markets. Markets open in 22 minutes. And don't believe the hype. I do not believe the markets are going to be up today. And I don't believe the VIX is going to be down today. I believe interest rates are rising. Stocks are falling. It's been that way since the 1800s. You guys take care now. Bye-bye.